So first of all, thank you very much to my friend and colleague, Mr. Francesco Castelli, who came from London to give the people on online via Zoom and the people in the room at University of Padua some insights about not only the fixed income and the credit markets, but also about artificial intelligence and applied on his job. And some other questions you might have in terms of career, jobs, what's the weather in London like, and anything you want to ask him. I'm Marcello Zanardo, I'm professor from this year at Padua University with the course of Professor Francesco Zen, and my seminars and topics are on financial markets. With Francesco is the first of a series of distinguished guests. With Banor Capital, we will then have Amundi after Banor, BlackRock, Giotto Cellino, General Investments, and so on. And clearly, Francesco has also been quite a regular contributor on our Mercury Partners Academy fixed income markets updates. Having said that, I'm gonna give him the room to Francesco, who's gonna take you through the wonderful world of fixed income. So in terms of managing the time, I would say it's 2:32. I would call it maybe an hour or so between the presentations, and then what you're gonna show us on artificial intelligence. And then maybe 20 minutes for Q&A, both from online and in the room, of course. Just a final check. Can you all listen to us from online? All is good? Having said that, I leave the floor to Mr. Castelli. Thank you, Francesca.
Thank you. Honestly, how many of you feel like this is going to be the most boring presentation being fixed income? Come on, guys, don't be shy. So fixed income wasn't exactly my dream job. And Marcello always asked me to give also my advice for young people like yourself, and to find the best way to get into the job market in finance, for what I understand. And first word of advice, especially if you get employed by a large bank, a large asset manager, you will not choose the job will choose you. So when you enter an analyst program, a summer internship program, things like that, your job is to make the most out of it, and making the most out of it will mean that some vice president, some managing director will put their eyes on you and say, you are my guy, and I want you to come back after that. But you will not know if this is going to be in equities, in investment banking, in fixed income. And so, word of advice, be flexible. Unless you are really very much in love with something, keep your options open. I started in FX, foreign exchange, and after 5 years in university, so undergraduate plus masters, and having studied a lot in derivatives, because at the time derivatives were something really important and everybody was writing thesis on how to price derivatives. And I ended up in the FX market, and without knowing that was the wildest, most exciting place for a derivatives trader. And nobody told me in uni that was the most exciting thing you could have ever done. And so I was very skeptical at the beginning, but I really enjoyed the job. I really enjoyed it. And so, then I getting older, I said, oh, let's switch to the boring fixed income, right? The presentation has been built, and around what you are less likely to hear in a classroom and what you are most likely to hear during your first job interview. Okay, so these are the questions I ask my future assistants, and you should expect that anyone interviewing for a fixed income presentation will go through these things. The idea is that give you a few things and tricks to reason like a fixed income investor and to understand what we do in our job and what we look for when we try to hire new people. And you will see a few, say, maths brain teasers in the slides with the. So next time you end up saying, "Oh, great! I got a job interview with Goldman Sachs." Oh gosh, it's in fixed income. Bore me. Okay, go over this presentation. Look at the brain teasers in this presentation. It's going to be a very, very easy refresh session for your next job interview. So, fixed income market. Yeah, sure. This is a picture of the fixed income market. It's very important, and maybe you don't learn it much on the books. That the fixed income market is half of it is government bonds. So bonds with a limited risk of default, very limited risk of default, and that's the basis of what you learn in a financial maths class about fixed income securities. Securities will pay a constant coupon over time, and at a certain point your capital should come back to the rightful owner, right? It's very important to know that most of it is issued in US dollars, either by US entities or by other entities. So the US dollar market is massive, much larger than the euro market, and much more liquid than anything else. So in terms of liquidity and behavior of the market, what we have in the US dollar market is very different from what we have everywhere else. And for us fixed income investors, even when we're based in Europe, the US dollar market is very important. The other thing that maybe you don't realize when you are outside of the bond market is only half of what we call bonds are issued by governments. The other half is issued by a lot of other entities in a lot of other shapes. And actually the dull bit of the fixed income market is mostly this area here, the treasuries, because here you have, in terms of price, you have only one risk, duration. We know that rates move, they move every day, every single second, and the price of fixed income securities will move accordingly in the other direction, of course. Higher rates, lower bonds. All these bonds here, they have other risks. So they have a duration risk, like fixed income government securities, but they have a host of other different risks. So this bit for a mathematician and anyone with an analytical mind, this bit here is really, really exciting and interesting, because the level of analysis in this bit becomes much more interesting. Right? These are rating scales, very important for whoever invests outside of the government bonds, because it tells you how much risk you are bearing. And in particular, if you are buying securities with ratings in this class, you are also taking on board a lot of credit risk, so a lot of additional risk in addition to the interest rate risk. And this is the area that I'm most excited about and my specific area of expertise. Government bonds are no, yes. Credit securities, no, because you have every day you come to the office and basically you look at your portfolio and say, oh my God, this guy is about to default. That's a problem. Right? So that's a kind of excitement, which is kind of similar to what equity investors would experience. Right? First important point, ratings are generally expressed as with letters, right? We have different rating scales so that the text string is a bit different between different rating agencies. But as you can see, the scales are produced in a very, very similar way. So you can work both on single ratings, understanding that a Baa3 for Moody's is more or less the same thing as a triple B minus when expressed by S&P and Fitch. The important bit that, and the bit that escapes most investors, is that the probability of default, so the probability that your money will not come back by the time the bond expires, it's very different. So it doesn't increase linearly with these bonds being riskier than these bonds. It increased exponentially. Okay, so the first mistake that a lot of people do also in our profession is that the idea that a portfolio where you have half of triple B and half of single B has the same credit risk as a portfolio of 100% double Bs. Is not like this. Rating agencies, Marcello knows better, rating agencies, when calculating a portfolio, the average rating of a portfolio will convert every single letter to a number. This number is it's proportional to the default rate, and then they will calculate the average of these numbers, and the average result for the portfolio. So the average rating number will be mapped back onto the ratings. So in this short example, if you prepare a portfolio for the sake of example with half of the portfolio single A, half of the portfolio double B, you might be thinking, oh, you know what, the average rating will be around triple B. Is not the case, because the default probability of this portfolio will be 0.5% times 0.1%, which is the average default rate for a single A. 50% multiplied by 1%, the double B risk rating. And if you do the maths, the average default probability for this portfolio is going to be 0.55. So if you calculate correctly, the average rating of this portfolio will be lower than a triple B, because the default probability is higher than a triple B. So it's going to be something more or less in this scale. Okay? Very important, tricky thing. Why it's important to talk about corporate bonds? Well, the importance of corporate bond is that generally, textbook case, you know that there are equities, green line. You know that there are government bonds, orange line. Basically, textbooks tend to forget about all the things in between. So we know that government bonds are dull but relatively safe. So over the medium term, they don't earn much in terms of total return. And historically, they've been underperforming equities. We know that equity tends to do much better, but they are much more volatile. The interesting bit for investors and traders alike is that there's a lot of other financial activities between the two. And so risk and return, there are a lot of risk-return combinations between the two extremes of bonds and equities. And by the way, this area is also considerably interesting from a job perspective in terms of remuneration, career progression, and stuff. So of course, if someone says, oh, well, government bonds are dull, we may somewhat agree, even though bond traders, there are very successful bond traders that have made millions, if not billions, in some cases. So I wouldn't discount the opportunity of working on a fixed income government bond desk. But yeah, just bear in mind that when we talk about fixed income, there are a lot of things in between, and some of them are really, really exciting. Almost equity-like exciting. That's in terms, to give you an idea, return on volatility. See, they nicely align on what is the current rate on the government bonds? Well, I don't know, because it moves every single second. But the interesting bit is that you shouldn't look just at one interest rate, and that's the beauty of fixed income. When we talk about fixed income, there's a yield curve. So the yield on a 1-year bond, 2-year bond, a 3-year bond are all different. So when you think about equities, you think about a single data point. And so the S&P index goes up and down. Fixed income investors, they have a superior mind because they, joking, because we need to think in 3D. It's not 2D. So figure your equity index and goes up or down. The fixed income market is not a single data, it's kind of a snake. And so when it moves, it goes like this. And so the movement is not a single point, is a string of points. And they are not aligned, and the shape tends to move over time. There are people there are traders that do not trade at all the direction of the snake. They just trade the shape of the snake. And so it's a bit more complex on a mathematical point of view. And we always joke that our equity colleagues, they're not very good at maths as we are. And but yeah, it's a point being that equities, you have to take into account a lot of factors, and there's a certain degree of fuzziness, and also intuition maybe plays bigger role. To be a good equity investor, you have to understand what you are buying, and you have to kind of trust to a certain extent the people in charge of a single company. And so it's something that is less quantitatively understandable, even though I'll show you at the end of the presentation that artificial intelligence is getting there. But yeah, for fixed income investors, the precision and the calculation is key. And so we really are interested in people with a lot of analytical skills, because there's no hiding. Either you know your maths or you don't. And,
we'll leave the question maybe not at the end, but let's have 2 or 3 stops during the presentation so that we can ask questions. I will put the arm and say question time. I always wanted to do that. Yeah. Okay.
Correlation of asset classes, very important. Have a look. High yield are not correlated with government bonds. So despite being fixed income securities, they are correlated with equities. And this very correlated with equities. This gives you a hint that if you end up on a high desk, you will get as much as the same excitement on an equity desk. And you will be talking about really disgraceful companies. So it's kind of this gross feeling of dealing with rogue companies. Sometimes it can be exciting, let's say, for some types of professional investors. I find it exciting. Okay.
Maybe just go back a little bit to the correlation, just to see what is more correlated.
Yeah, as you can see, government bonds are very correlated with corporate bonds. Zero correlated with high yield. This is a very long-term correlation matrix going back 25 years. There's some correlation between government bond and emerging market fixed income securities, so securities issued by emerging market governments. And And yet, generally, government bonds and equities are not correlated. They have a slight negative correlation, even not that much. So it's interesting because the difference between corporate bonds and high yield bonds is just the fact that high yield companies have a lower rating, so that they have a higher risk of default. So basically, these two securities, corporates and high yield, have a package of fixed income risk and credit risk. In corporate bonds, where defaults are relatively rare, you get a package with a lot of interest rate risk and limited credit risk. Also limited extra spread. So the yield of a corporate bond is very similar to a government bond. Okay. So say in Europe, government bonds along the curve, they are around 2%, depending on the point of the curve. Corporate bonds, they typically yield around 3%. High yield securities in Europe, they typically yield 5%, so much higher. But you get a much higher credit risk in return. So that's why corporate bonds and government bonds are so correlated, because corporate bonds, they tend not to default too much. So most of the risk you get when you buy a portfolio of corporate bonds is the risk of interest rates moving around, right? And dragging along corporate bonds. So duration risk. When you buy a high yield, most of the risk is that the bond goes bust. And so it's more correlated with the equity sentiment, so the fact that the economy is going well or not.
Or the sector where they operate is going also.
It's not super updated, this one, but gives you the idea of where curves are. Actually, we are a bit lower now. Okay, that's in US dollar. Of course, as you know, interest rates in different currencies are different. The first point of the curve is decided by the central bank, setting rates. The rest of the curve is decided most times by investors, and are kind of betting on where the interest rates will go over time. So the 1 day interest rate, the interest rate I get to deposit my money 1 day with the central bank is set by the central bank. Changes every 1.5 months, potentially, but for the next 1.5 months, we know exactly how much money we're going to get back on a 1 day deposit with the central bank. The investment for 2 years, we don't know how the central bank will set rates on the next 2 years, and so is us investors guessing. And so the price of a bond in 2 years' time and the yield of the bond in 2 years' time is set by the market. And the market tries to infer where rates will move, central bank rates will move over the next 2 years.
Maybe explain, Francesco, very clearly the relationship between price of a bond and yield.
Yeah.
And why they are inverted.
Very important. Yields going up means price going down. Okay. And why it is so? Well, think about it. Let's suppose I buy today fixed income security, a 2% fixed income security, right? So I'm going to get 2% every year. And let's say maybe we get it for, I don't know, another 2 years, okay? 2-year security, 2% coupon, okay? Very good. The moment the central bank changes his mind and suddenly from 2% moves the rates to 3%, as an holder of a security with a 2% coupon, I have a problem, because if I want to sell it, the rest of the market participants will want a 3% return for the security. So if you do the maths, I'm losing a kind of 1% per year, right? Yeah. With respect to other securities. So the price of the security will move where?
Down.
Down how much?
Up.
No. It's a 2-year security. rates moved by 1%.
Discount like 1% for 2 years.
Yeah.
I don't know what is specifically, but
So
2%.
2%. These two is the, well, actually a bit less than 2% because you are discounting cash flows in the future. But these two is the duration, okay? The sensitivity. Of course, on a textbook, you read always what's the definition of duration? Anyone?
The sensitivity to.
Okay, that's a definition we like in the financial market. It is the sensitivity to changes, small changes in the interest rates. So we are assuming a parallel shift of the curve. So when you talk about duration, you are imagining a flat yield curve, and you imagine that the curve moves up and down. Okay, parallel shift. Duration is very important because if I tell you a bond has a duration of 2, you know that for a 1% move in one direction of the rates, the price will move in the opposite direction by 2%, twice as much. Okay, that's the
longer the duration.
Okay, a 10-year bond, and the definition of duration refers to the average value of discounted cash flow in the future. So since you are discounting cash flows in the future, it's important. So it's the average maturity of the cash flows you have in the bond, right? So the longer you move, and the maturity doesn't increase proportionally to the maturity of the bond. So for instance, a 10-year security with a 2% coupon will typically have around 8 years in duration. It's not 10. The security is 10 years, but the duration is 8. So suppose rates move down by 1%. How much will the price of the security move? Rates down 1 point. Price down, up by?
It's by 2.
No,
8.
8.
8 is the duration, 10 is the maturity.
Okay.
So?
By 8.
Yeah, 8%.
8%.
Okay, 8%. So if the security is priced at 100, we'll move to 108. Typically, bonds are priced in hundreds of percent, right?
So this is crucial that you understand. If you don't understand this, you don't understand bonds.
Okay, yeah, it's
this is like
nobody will ask you the definition of duration in a job interview. We don't care. It's a sensitivity. It's nothing, right? There's one exception. There are securities where the maturity is equal to the duration, and the exception is
0.
Well done. Okay. Which tells you another thing. The duration. So not all 10-year securities have the same duration. The duration of a 10-year security depends on the coupon structure. So higher coupon. So take 2 10-year securities. One has an 8% coupon, the other has a 2% coupon. Which one has the higher duration?
The 2%.
Right, why?
Because it has a lower coupon.
Yeah, and why the lower coupon structure gives you a higher duration?
Because the time in which the bond will be repaid is higher.
Excellent. That's the right reasoning. If you forget about it, think about it. The lowest possible coupon you can have, 0 coupon, higher duration. So the more you move to a 0 coupon, the higher the duration. Okay?
Which in this case coincides with the maturity.
Yeah. That's the kind of conversation you're going to have on a job interview for a fixed income desk. That's the kind of screen you will see if you end up working as a bond investor or bond trader. When we buy securities which are not government securities, we always compare them with the government security with similar maturity, right? This case is a General Motors bond, a bond issued by General Motors. And as you can see here, the yield was 6% versus the Treasury security with the same similar maturity which was yielding 466. The difference between this number and this number is called the spread. And the spread is the amount expressed in basis points. So in converting 1%, 146 to 145 basis points, is the amount that we earn on top of treasury securities. Why we earn more? Because General Motors has some probability of default, has defaulted in the past, despite being a very large company, but he has defaulted. So he hasn't repaid back the full amount of the bonds they issued. There are various types of spreads. Generally, you will look at spreads versus treasury securities, and you will look at spread versus the swap curve. One interesting thing is that the interest rate swaps, the rate on interest rate swaps is different from government securities. They are both interest rate curves that express kind of a risk-free environment, but they are different. And we need to keep in mind that those are two different things. They move along, these two snakes, but it's not the same snake.
Maybe going back, Francesco, just for them, if you use Bloomberg, it's important to memorize these YAS.
Yeah, that's the function name.
Which is the function of Bloomberg that will give you this kind of page where you look at the issuers and the coupon, that you see the spreads, and you see also other information.
If you get any opportunity of getting a Bloomberg also free trials for students, and if you really want to work in finances, it is by far the winning system on the desk of anyone working on the financial market,
especially fixed income.
Especially fixed income, but to be honest, they won the war. 20 years ago, everybody had a Reuters terminal, which is no longer called Reuters, by the way. And I remember when I started working, it was a bit more than 20 years ago, of course. And we had everybody had in front of him a Reuters screen, and there was a single Bloomberg in the trading room for everyone to share. Now probably it's the opposite, and you will find everyone with a Bloomberg screen in front of them, and maybe some in fixed income for sure. You cannot do fixed income without a Bloomberg. There are exceptions. Maybe swap traders in Japan, they still use the legacy system from Reuters. Foreign exchange traders, they use something else. Most equity investors, if they have access to a single system, they will use Bloomberg, not something else. There are analyst positions where maybe you want to use other systems, but yeah, getting some experience playing around with a free trial on Bloomberg is a safe bet for most of the front office jobs in context with the markets. This formula is interesting because it gives you a bit of a, so this spread is simply the yield of this bond minus the yield of this bond. So General Motors yield minus treasury security yield. This spread is a bit more complicated to calculate, but a bit more useful in a lot of securities. So bear in mind that this is the right formula to calculate the spread properly. And remember this formula. So you add to each single item of this summation, you will add the spread, and of course it is not something you can calculate. There's no closed formula to go back to this OAS, so it's trial and error. The system will go and find the right security, the right spread. The interesting bit so is that rates move around, as we know, like children. Spreads move around a bit less, but they move a lot, okay? And they typically move in cycle. So for us, credit investors, it's very important to monitor where rates are going, but also where spreads are. So we have this double risk of security moving potentially pulled by two different directions. And as you can see, it's very cyclical because over the history, here is from 1983, you have big jumps in credit losses, so defaults. These big jumps always come when there's a big recession, right? Beginning of the 90s, 2000, 2008 and 9, and a bit during COVID. And defaults are cyclical. Spreads, obviously the spreads will follow the default cycle. When we start to see a lot of companies defaulting, generally we know that defaults will come all together, so they are not evenly spread over the history, and spreads will move around because nobody wants to hold risky securities when you see that defaults are happening. And you know that historically defaults tend to have clusters of defaults. So when you start to see a lot of defaults, you say, oh, there will be more around the corner. A lot of people will leave credit securities. If I sell a security, the price move
down, yes.
The yield of the security move up. But this is a credit security, so the yield of this credit security is going up. Government bonds are staying the same as yield. So the spread will widen, open up, okay? And it's interesting because generally, when you think interest rates move up, they move up because the central bank is hiking rates, so the economy is going which direction?
Going down, usually
when you hike rates.
The economy is good, there is inflation for trying to contain inflation.
Exactly. So the economy is booming. Okay, yes. Economy is booming, interest rates go up because the central bank want to cool down the economy a bit. Yes. They are taking away the punch bowl, like from the party, right? In such a situation, do you think companies will default or not?
If they are highly exposed to credit, probably they could.
Well, if the economy is going really well,
no.
Companies, they shouldn't default, right? And that's interesting because interest rates move up, credit spreads will come down because everybody says, oh, the economy is booming. Yeah, well done. And so companies do not default in this phase, typically. And so you have an interest rate risk that moves in one direction, a credit risk that moves in the other direction, okay? Securities with a bit of, securities with a lot of interest rate risk and a small credit risk, corporate bonds, high quality corporate bonds, will follow the price down like treasuries because they are very correlated to treasuries, and most of the risk you have for a high quality security is interest rate risk. High yield bonds, they are in an entirely different situation. Because if this is the treasury return, investment grade high quality companies, they will have a lot of risk, interest rate risk, and very limited spread risk, right? So if a company is really good, Apple, of course there might be a recession, but they're not going to go bust, right? General Motors, it's a different conversation, okay? So, and this gives you a very interesting intuition. When yields move up, generally also investment grade yields will move up a bit, not because these companies are riskier, but simply because we want to keep the same spread with respect to treasury securities. So interest rate up, bond price is down, corporate bond price is down. What about high yield securities? Well, with high yield securities, the situation is a bit different because of course this yellow bar will go up because this is the treasury risk, right? On the other side, the economy is booming. Is this big spread justified? Well, probably not. These companies are not going bust. They are high yield, very leveraged, but the economy is booming. They will pay back the debt. So you have a lot of instances in which treasury yields go up, corporate spreads move down. For investment grade spreads is not going to be enough to compensate. So big movement in interest rates will have a tiny movement in corporate spread. It's already tiny, this spread. It cannot move down by much, right? For high yield, where you have a big, fat corporate spread, sometimes the spread compression is enough to compensate for higher yields. And that's exactly the reason why we had this correlation in this matrix. High yield have zero correlation over time with respect to government bonds, because over time, generally, when you have losses on corporate bonds, when you have losses on government securities due to higher rates, you have gains on the other side from spread. And for high securities, this is enough to compensate for the higher interest rates. Of course, the opposite is true. So the economy doesn't do very well, plunges into a recession. Central banks will cut rates. Treasury bonds will move up or down in price. Up in price because the interest rates are plunging, because it's an emergency, the central bank has to do something. What happens to corporate bonds? Well, corporate bonds, yeah, those are high quality companies, so in general, even if there's a recession, they will not default. But of course, maybe the credit spreads will move up a bit, but still, in most of the cases, they will follow government bonds. So they're very correlated, also on the way up of the prices. High yield, different, because most securities will have investors saying, there's a recession, I'm not going to invest in high yield bonds, not right now. So the spread will expand a lot, and generally this expansion is enough to compensate the positive. So expansion in spreads, prices go down, and this is generally is enough to compensate for the positive effect from treasury securities. And don't forget, when there's a recession, a lot of these securities, you will stop thinking about duration and thinking about price, because you will be in front of a judge, because these companies don't bust, right? And so all the duration arguments will stop because the company is gone. You will have the slides. Have a look at this, because this is the typical applied math we use on the desk. And so this will give you approximations. Those are just approximations. Of course, we have tons of machines on the desk that will do the exact calculation for us. What we try to understand when we have in front of us a student, a potential new hire, is, do you understand what's going on? Because that's the difference, right? I had a conversation with our risk manager, which is a guy who's got a master's degree at Imperial College, so certainly well prepared. Put me in front of me a simulation for the risk of a portfolio using a technique which is called value at risk. Put the number, this is wrong, I gave it back. How do you know? Yeah, of course, because I know what I'm doing, and I know when a number is wrong. Okay, so that's the difference, because and that's what you have to bring to the desk. We have a lot of computers, more and more computers, and we will need less and less people. The people we need have to be really skilled. They need to understand what they're doing, because that's the way you understand when a machine is wrong.
There will be fewer jobs, in my opinion. There will be new jobs, but there will be fewer jobs. You will not have a pension. It will be difficult to find a job. I'm not kidding. It's serious. That's why you need to take any occasion to really find out what you're good at, what you can do, because it will be more difficult. I mean, also because if we look at the debt around the world, it's gigantic. especially after COVID. So public finances are already stretched, even in the United States, which, the 10-year yield on a treasury could well go up to 6%.
Why not?
Why not? The debt is gigantic. So we're trying to give you some notions in the real work environment, because competition is fierce. And I think that just to break a little bit the very interesting conversation, but to breathe a bit, because those are key concepts. In the past, if you attended a master's or a university with a very good name, you were almost guaranteed, to find a job, a good job. That's not the case anymore, because jobs are fewer and competition is higher. Close parenthesis. And this is my great encouragement to you.
Yeah. I think in the interest of time,
Yeah?
maybe.
Yeah, you can skip a lot of
yeah.
stuff. They will have.
Have a look if you're interested in fixed income, along with what you learn. And I'm not saying you don't have to learn you don't have to unlearn what you learned in a financial maths class. Just use these slides to understand where these things that are theory leads in practice. Okay, it's very important. Those are brain teasers that I think are very likely to come up in a job interview, and so they came up over my career when I changed job. So I took notes, and then I think it's interesting. So, and if you are interested in working in credit, don't stop to this to the equation here. To the equation here for government bonds. Try to go also over these equations. It has to be behavior of excess return. So how much is the evolution of price of a corporate bonds with respect to government bonds? We always compare them, because the reason my clients entrust me with money to be invested in credit market is that they believe, that I will beat corporate bond, they will beat the treasury market, right? And so the government bond securities are kind of a benchmark we have to beat as credit investors.
Like in equity, you need to be compensated for the risk with the equity risk premium over the risk-free rate. Yeah, the concept is similar.
Yeah, and it's very important for us investors, especially investors in funds like myself. We are valued every single day. Every single day, the funds I manage will publish an NAV, a price. So every single day, the clients will look at what I'm doing, if I'm doing well or not. And so it's not important. In theory, we say we are long-term investors, and so I buy a 10-year securities because I want to hold it up until the maturity, but that's not true. There are institutions like maybe insurance companies that really tend to hold the securities to maturity, but in many other cases, we will flip around securities very frequently, let's be honest. And we are interested not as much in how much we are going to make in 10 years' time, but unfortunately, the industry forces us to do well over the long term, but also do well in the short period. And so it's these kind of calculations will show you how these brain teasers will show you how you should interpret, you should connect the movement of an interest rate to a moving price and the move in spreads to a moving price and extra return. Okay.
Did you want to go to AI?
Sure. Okay. So, artificial intelligence has been applied to financial markets for a long time, well before Gen AI became the word of the day. So well before 2022. There are we already use a ton of machine learning techniques, and a lot of the techniques that are currently used by LLMs today were first experimented in finance, to be honest. So it's not something new. Technological evolution has been part of the life of financial companies for a lot of time. And after a few decades in this field, and at the beginning, it was the job I was doing at the beginning was kind of 13 people in a room moving different currencies around the world by phone. We had phones, and we were asking, can you trade $5 million, and can you offer a bid ask in a file? And the guy on the other side will shout back a price, and you choose either to buy or sell, and what's the buy, right? We had fax machine, if you know what they are, sending confirmations back, and I would pen and paper, I would write down every single trade I was doing. I was passing to a guy, and would send me back the proper copy, and I would sign it off at the end of the day. So it's certainly this job that was done by 13 people now is done by a single machine. So it's automation has been part of the financial sector forever, right? And but it's picking up pace, and so we have to bear in mind that it's picking up pace. The beauty, I think, of Gen AI and the technology we have nowadays is has become very easy to use. So you certainly would benefit knowing programming languages. Python is the safest bet if you want to work in finance. If you want to work in high frequency trading, you should probably have a look at C++. C++ is a much faster code, and so for many applications, you would probably prefer C++ for implementation and not Python. It's also true that with Gen AI, it becomes much easier to learn any language because ChatGPT is already programming for you, right? So you have to know the logic behind it, because every now and then it doesn't exactly know what it's doing, but if you know a couple of tricks, you can progress very rapidly also learning to program in Python. I'll show you a few things that used to be in a much slower way without machines, because there are a few things we do in our jobs that are difficult to automate. For instance, one activity is that, every month and a half, the Federal Reserve will decide the level of interest rates. The thing works that at a certain time, which is generally 7 o'clock in the evening for us on this side of the world, Federal Reserve will announce rates. So they will shoot this statement, and the statement contains a reference to the level of rates here. And so you see in December, they decided to lower interest rates. In January, they decided to maintain the level of rates. In many cases, we already know where they are going. So by the 31st of January, everybody knew they wouldn't touch rates, because in the previous day they said we wouldn't touch rates. There was no big despite Trump asking them to lower rates, they said, no way, guys, I'm sorry. Very good. The interesting bit is that once we had an economist reading this bit, and he would shout in the box, in the microphone he has in front of him, he would shout for the rest of the trading room what the central bank was saying in the press release, and how they were likely or not to move rates in the future. So we knew today nothing done. Okay, very good. What's more, So the economist will go, will read the statement, and will shout to the rest of the room, listen, I think from what they say that they are more likely, less likely to move rates. And then the traders, on the basis of what the economist just said, they will decide, oh, I'm going to buy treasury securities, I'm going to sell treasury securities. If I'm buying treasury securities, it's because I believe that the Fed in the future will do what? Cut rates. Okay. Very good. Now, this job is done by machines. So this will be published on the Federal Reserve website and on a lot of other newswires, Bloomberg, Dow Jones, and will be published exactly at the same time, okay, exactly at the same millisecond, because this is immediately fed to machines. Machines will look and will compare the two statements, the December statement and the January statement, and in a fraction of a second, generally well below 1/10 of a second, they will interpret what is written there. They will decide if the Federal Reserve is more likely to cut or not in the future, and will buy, without human intervention, buy or sell treasury securities. And there's no way a human can do it. Because machines are much faster than we are. So the trading around the press release was a great fun for us traders maybe 20 years ago, is no longer done by human beings. So you can really see if you have an intraday chart of these securities, you can really see it. Another thing, and this is really simple because the statement is, you see, is not particularly long. It's half a page, right? After half an hour, Mr. Powell, the central banker, will come out and will start speaking to journalists. Well, some of those journalists, despite coming from the best newspaper around the world, don't know anything about finance, unfortunately, so they will ask silly questions. And most of them will ask interesting questions. Unfortunately, there are only journalists, not traders, for an obvious reason. Some journalists have very good friends among the trading community, so they will get the right questions to be asked. Computers are now passing every single second those conversations and deciding on the basis of what they say if it's a good time to buy securities, sell securities, right? And they know it because they are comparing the transcript of the conversation real time with the press releases and press conferences of the last 10 years. And they do it in real time, right? And that's why if you go, for instance, on the ECB website, there's a link to the YouTube press conference. You don't have to look at the, I mean, yeah, you can look because there's a theory that Madame Lagarde wears clothes of a certain color if she feels more aggressive, hawkish in the, or less likely or more likely to cut rates, dovish, as we say in the market. So she always wears very beautiful tailleur and of course she's French. She's got lots of taste for these kind of things. But yeah, apart from it, you don't need to look at her. What you need to do is click just on the bottom, and you will find a link called low latency feed. Because traders and machine will not listen on YouTube where you have a 2-second delay. They will listen on the low latency feed where it's real time. So you are the first among other traders to listen to what she says. And your machines will be listening to the low latency things and trade accordingly. Very funny because I have an equity guy next to me who looks at the, and he has a reaction, so 2 seconds after. I say, how are you doing, guys? I mean, don't listen, you don't understand anyway. So, and low latency is very important for this kind of thing. If you have enough space, like Bloomberg did, to collect all the Fed speakers, you know, in the Federal Reserve and in the ECB board, there are multiple members. They vote together. So, of course, the guy you always see is Mr. Powell in the US, Madame Lagarde in Europe, but the decision on rates is collective. Okay, so there are roughly a dozen of central bankers in each board. And one thing that we human used to do, and for a part of my career I was in charge of it, every single day there would be some Fed speaker talking about the economy, but excluding the period 15 days leading into the central bank meeting. These Fed speakers, they will express their own opinion. They will start the speech saying, it's my own opinion, it's not the Federal Reserve opinion, but of course, this guy is going to vote in 15 days' time, so it's important. And it's possible, and it's done by most research houses doing this, they will do it. You can collect, and in this case, they collected 6,200 speeches since 2009. And each time a Fed speaker speaks, an LLM, a large language model, will compare the latest words with the words she or he said the month before, and then the month before. And based on her attitude towards the economy, towards monetary policy, they will decide if these are more aggressive, hawkish words or less aggressive, dovish words. And you put everything together, you compare it with the outcome in terms of interest rates over the course of history. And Bloomberg has produced this thing that you can find in the Bloomberg terminal, which gives you the probability calculated by Bloomberg and by the LLM employed by Bloomberg that the next move in interest rates is going to be a hike in rates. This again was a human, very, let's say, was a soft skill, trying to read the leaves, understand what the central bank is going to do. Now it's become a very quantitative outcome. Okay, that's something we've done. I've done for my company, and yeah, and it's interesting because it's very easy to produce. And I think in the future we're going to have a lot of these tailor-made LLMs, right? So, and now it's become so easy that even I can produce, and I'll show you that you don't need any code, you don't need, what you need is a good database. So the idea is that an LLM will work on a very generic, set of informations, right? So whatever an LLM can find on the World Wide Web, right? If you want to specialize content, maybe documents that your company is working on, databases that you are working on, there's now a very easy way of sharing it with your colleagues, with your clients, even though sharing with clients, of course, especially in the financial sector, you have to be really careful, because whose responsibility is if the outcome is not exactly what you want, right? Yeah, and it's so if I can, the interesting bit of this GPT is that in a very few lines of code, basically we in my company we share notes among analysts using OneNote, which is the standard software you find on any Microsoft package. It's interesting because you can combine in OneNote a lot of things, and very easily, and so you can combine notes, you can combine charts, a lot of things, right? And the beauty is that it doesn't take much. Once you've written this, the point is that you have to write notes, and as Marcello knows, a large part of our financial career was spent in crafting very carefully research notes to be shared with clients, right? And so, and to be shared also internally in the bank, in the asset manager. something that takes a lot of time. So sharing information inside a company is relatively easy, but takes a lot of time. This form of techniques, they enable companies to share the knowledge instantly inside the company without a lot of delay. And I'll show you. So think about it. This GPT just contains notes we analysts have written, nothing more than that. Notes that are not particularly clean in their form. The content is very good, but they're not always clean. Sometimes they're just drafts, right? If I type the name of a company that I know is in the database, well, first of all, it will answer in Italian, sorry, because since we have a lot of bankers, Italian bankers, the default has been in Italian. Let's ask. We'll switch immediately in whatever language you prefer. So there's, of course, a disclaimer, so compliance is happy. And then the LLM will pull out of my notes, so the notes I've written, and will explain to my colleagues what I think about UniCredit as a company. In this case, I'm also the analyst in charge of this company. See, and he's going to pull from tables, from text, from a lot of different sources. This note might have written in English or in Italian. We use both languages, and it doesn't care. It will translate the note. We'll also have an update on the proposed transaction with Banco Popolare. And the beauty that on top of it, so we'll write a short note, because I told the LLM, write me a short note. But we'll also be happy to interact with me. For instance, what is Mr. Orchel promising in terms of 2025 results? Mr. Orchel is the CEO of UniCredit. We'll go, fetch informations, answer in Italian. Anyway, so that's annoying, but yeah, there's a lot of people in my company that prefers to speak in Italian, as it should be. So it's interesting because, this gives us a very interesting tool. Of course, we already have a well-fed database, and that's a value. But delivering the database has become super easy, and I'll show you how I did it. Okay, so you need a professional $20 a month ChatGPT. Of course, it's not for free yet. Modify GPT. You should have a slide showing that in the deck. And configure. As you can see, and this is all what it takes to prepare this GPT, okay? As you see, I gave the GPT a page of instructions on how to craft the answer, but it's all natural language. So I'm writing in my own language. I have to be precise and use precise words, because the LLM will pick it up, will understand that I am a financial analyst, we're not in a I don't know, tailor shop, we're not in the fashion industry, no, we are in finance, okay, we'll pick it up. But so a few words that I want to appear on top of my GPT, just to entice, and then I will upload a single PDF where I compacted all the database. And that's it. You go here, you configure it, you click it, update, and it's done, right? So it's a very easy way to produce a your own GPT with your own material and delivering to whoever is your audience.
Should we take maybe question?
Yep.
Okay, great. Thank you very much. Why don't we start questions from the room? Anything?
Yeah, I have a question. Now, obviously, there are many ways you can earn a return with fixed income, but let's say most of the times when you're buying a bond, are you most interested in the interest rate yield or on price swings to gain return?
Yeah, it depends on the period.
Okay.
For instance, at the end of 2022 was a horrible year, probably the worst possible year in my career, fixed income, and we got a huge jump in yields. The interest rate curve generally moves by 1.5 points in either direction in a normal year. So in my career, most of the time I would trade the shift in interest rate, aiming at gaining maybe 1%. When I guess in the right direction for 1%, I'm generally done. Okay, so I take profit if I was on the right side. In the case of 2022, the shift was on some curves by almost 5 points. So absolutely unprecedented. Okay, very much. The year after was much better. And so, for instance, in 2023, despite being a credit investor, at the end of 2023, we recommended to clients and to our colleagues go long duration. So we said extend the duration, the sensitivity of your portfolio. If you have a sensitivity of 2 years, move to 3, move to 4, move as much as you can. Okay, so in those specific, and it ended up being a very good recommendation because November and December 2023 were the best 2 consecutive months ever in fixed income. So of course, if you can guess the right direction, and central banks were changing the tune, they stopped raising rates, they were starting to hint, oh, we're going to cut rates in the future. So it was a very good 2 months period. So in those periods, you focus a lot on getting a price increase, right, in your portfolio. But as a fixed income investor, you have to remember that it's very difficult to guess the direction of rates because everybody else in the world is trying. And huge amount of machines reading the pages of the central banks. So beating the rest of the market is not that easy. What we generally do as fixed income investor most of the time, and we try to earn the carry. Okay, so we know that every single day, including Saturday and Sunday, fixed income securities will produce money. So in most cases, we want to be invested. Of course, there will be time where you want to be invested and earn carry and have also a lot of sensitivity to price increases, so long duration. But even when you don't feel confident, or maybe when you feel that you're going to lose money, it's better to remain invested and shorten your duration. Because fixed income securities will work for you, including Saturday and Sundays.
Exactly. So if you have cash, for instance, and you have dollars, you are an American person or you have a saving account in dollars, and you say, I don't really know if I should be invested in the equity markets now. Let's say you can do whatever you want. You are not on a benchmark. You're not, you put your money into 3 months or 6 months US Treasury bills, and you will get 4.35%.
Something like that, yeah.
4.35%, which is not bad, right? In the meantime, maybe you see what the equity market is going to do. Maybe there is a correction, 10% down, or we spot with my team the best securities once we finish invested.com and Yahoo Finance. And then we find 5 champions we're going to invest. We take the money out from the treasury bills, but in the meantime, you have earned a carry, an interest. This.
So the generally as a fixed income investor, and sometimes it's also written in your mandate. And so you have to remain invested. It is wise to remain invested. What you generally do is that there are periods where I want more or less duration, exposure to movements in interest rates. And of course, I want duration when I think interest rates will continue to move down, as in the case of the last few months. And then the other big bet I do in the portfolios I manage is the amount of credit risk I want to own in that specific moment. So do I want riskier securities, so lower ratings, or do I want safer securities? So I move between high yield and high grade, and I bet on the sector where I think the carry is going to be better, but also the risk of a credit loss lower.
So a question here from about scenario actually in Europe. Talking about Trump administration, I think that Trump wants in the last Fed reunion that Powell go out with like a purple tie, but it doesn't. It came out with other news. After the halt of actually interest rate, we know that a lot of economists actually think that Trump probably would prefer to have like a weaker dollar actually, but it has some contrast with the Fed, for sure, we can see. And with halt of rate, it probably we will have a more strong dollar compared to other currencies. And what I've been thinking about, like how it happened other times during the history, is that usually the central banks or the government try to appreciate other currencies to buy other government bond. So what I'm actually asking is, do you think that the European bond market could have like some sort of appreciation based on the fact that Trump would try to devalue the dollar by buying our bonds?
No, I don't think the Federal Reserve will not, the Treasury will not intervene. So I don't think buying European bonds is on the agenda. Just to give you an idea, yeah, a lot of people believe that the dollar might strengthen, but I don't think. Bear in mind, there's a lot of talks about the dollar, but the U.S. citizens, they don't care. The Federal Reserve doesn't care either. Why? Because the U.S. economy is the largest in the world, and there's a very strong correlation between the size of an economy and the openness of an economy. So the degree of exchange you have with the rest of the world. And bear in mind, and this is very important, the Federal Reserve doesn't care. Why? Because the US economy is very closed, not open. Okay, so if you take the statistics of imports plus exports as a percentage of GDP, the US economy comes up as one of the closest economy in the world. The exception being North Korea, probably. Okay, because there's no exchange with outside, and we don't know how the GDP of Korea is, by the way. So it's very important that from a macroeconomic point of view, the value of the US dollar is much less important for the US than for the rest of the world. And so, apart from what Trump says, I don't think the Federal Reserve will look that much at the US dollar. In terms of European bonds, the big question mark right now, government bonds, is how much money would Germany spend after the elections. Germany is one of the strongest countries in Europe in terms of debt to GDP. It's one of the lowest, with the exception of Luxembourg and a few others, because they never want to. They want to have a very safe government bond, and they want to never waste money. They ended up having 2 years of recession straight, which is quite. So we think that there might be some room after these elections for Germany to spend more, to have more debt, and this might have an effect on European government bonds, lower. More supply of bonds, lower. Any other question? Sorry. So
How is it?
yeah, please. And then you please go ahead.
How is it different working now with respect to the zero interest rate?
Yeah, for fixed income investors, we spent a few crazy years with zero interest rates, and I was lucky because I do credit bonds, so I never bought anything with a 0% yield. But government bonds investors were forced for a fairly long amount of time to buy securities yielding less than zero. So it's
The German bull, you actually had to pay
negative rates.
negative rate.
Was kind of crazy. That, as you might have seen, we had a lot of mathematical models on the shape of the yield curve that are based maybe on logarithm or something like that. So the moment the interest rates become negative,
Yes.
yeah, negative interest rates. When I was on the desk where you sit, they were just there was a fancy corner of macroeconomics saying that the optimal rate was negative. Well, it was considered kind of a strange thing. When it happened in reality, we had to trash Bloomberg, had to trash and throw away a lot of models they were using because they were no longer relevant. So yeah, it's very different. It's more fun with higher rates.
If I could ask, how do you translate your knowledge and the work of fixed income on your personal life investments? Since I think that you are very very bad at fixed income. So do you think or do you take advantage of the activist premium?
Yeah, of course. It's I think it's your allocation, your asset allocation should be in line with your time horizon. So especially for young people like you, the suggestion is invest as much as possible in equities. Once you can start investing for your retirement, you have to invest as much money as possible in equities because over the long run, equities are the best asset class for a private individual. So if you touch fixed income securities, probably is either because you want to buy a house in 2 years, and so for a 2-year time horizon, and for your savings, you don't have to buy equities, you have to buy bonds, okay? And after that big expense of getting the first house for your family, probably you should start putting in equities as much as possible, okay? Because unfortunately, every generation, we are earning less than our parents. You will be earning less than us, and so you have to be prepared. So you will probably touch fixed income securities more likely as a professional than as a personal investor. One piece of advice: I'm very experienced, more than 2 decades in credit securities. I've been buying corporate bonds for lots of time. I never bought one with my personal account. In some companies, I were not allowed for compliance rules, but the corporate investments, high-end investments, they require a lot of diversification, okay? So a well-diversified portfolio means at least 30 securities, okay? So my piece of advice is a fund, give the money to an expert. It's very difficult to have your own portfolio. How can you follow? I mean, the high-yield index is an index with several different corners and sectors. It's impossible for a single person to know everything. We are 5 to do this job, okay? So yeah, with the knowledge I have, and with the colleagues I have, and with my ChatGPT telling me all about the names you have in a portfolio, I could replicate the portfolio for my own account. But since most of high-yield bonds are now 100,000 each as the minimum amount you have to invest, and you need at least 30 securities to have a good diversification, you mean you have to start your fixed income high-yield portfolio from 3 million. okay, which is not something for everyone, okay? And on top of it, trading these securities from your own bank, you will never have the best price because
They will squeeze you.
yeah, they fixed income securities. Most of the trades are done over the counter, out the official market. So either you have 20 or 30 counterparties, as we do, or you will never get the best price. So as a private individual implementing your own portfolio, good luck. I would prefer to pay a fee to people like me, or if you don't want to have an active investor, buy an ETF. It's going to be much better for you.
Maybe last question here, then one online. Yeah.
Since the computers will do a lot of stuff for us, like computing and stuff like that, what kind of decision you make?
Well, I try to understand if the computer is right. Yeah, of course. I think, and this is, I think, is most relevant for people your age. We in the university and in the past, we trained you for a lot of things that now computers will do. So try to focus on understanding the things. You will not do it. So a lot of analyst jobs will be replaced. You need to think like an associate, so a third year analyst. Over time, I think you people from the university you are better than we were, because over your life, on average, you had exposure to a lot of things we wouldn't even dream, right? You can study with the help of ChatGPT. You have a lot of access to a lot of resources on YouTube. It didn't exist on YouTube when we were young, right?
However, you have much more infinite means, but it doesn't mean you have the critical capacity to discriminate what is good, useful, trusting, which comes with experience and with knowledge, maybe based on, I'm not one that looks at the past, say the past is wonderful, no. But I'm saying that as the situation evolves, it's like a guy who can have 100,000, 10,000 friends in Facebook and maybe spend the weekends alone in his house because he doesn't have friends, if I make this comparison just to... So you guys have a lot of tools, but you need to really understand the tools you have at their power, because if you don't, not only they can be useless, but they can be misleading. That's what I'm saying. So, yeah. So the potential is infinite, but you need to really grasp it and understand it.
A machine will do many more jobs, so it means that I need less analysts, less people helping me, but the requirement is still I'm in charge, that we will not have computer in charge for quite some time, and so we will need on this side of the job market to have more and more people understanding what they not doing things, but understanding what machines are doing. So I think experimenting with LLMs and artificial intelligence is interesting because it helps you learn faster, and companies will need more and more people that can direct machines. This is going to be, if you are interested in artificial intelligence, this is going to be the year of agentic AI, so agents. And we are starting to program computers like small analysts. They will do some small jobs for us. So we will need more and more people not doing the analyst job, but coordinating the various virtual assistants that are being created. So yeah, don't despair. I think you're going to have a lot of opportunities, but they're going to be different from what probably the teachers had in mind when they were teaching 2-3 years ago.
Yeah, also universities have to adapt, right? Because technology is so powerful and so quick that also, textbooks and everything has to evolve. Is there a question from the Zoom online?
Artificial intelligence, one last suggestion. have a look at deep research. It's a functionality that's been released by ChatGPT only for $200 a month users. So of course a bit of expenses. Has been copied in 5 days by this website, Perplexity. So the
please,
moment
team, make a note, because this is for us is very interesting, which I was speaking with them before. Perplexity.
Try to do the prompt. Try to use the prompt I used to do a research. This is I have a friend who does a private equity investment, and he's invested in something similar. I said, yeah, I use ChatGPT, but it's not that relevant. I use it a lot, but it's not that relevant. I cannot, for the moment, it's not to the level of my analysts. I tried with this, and I said, have a look and let me know what you think. And basically, in 10 minutes, you get a report that will be for one of your. And he called me back on Saturday night and said, what's going on? I'm not going to hire any analysts helping me because I have it on the machine. Yeah, you will hire someone who knows how to use it, which is very interesting because it means that we're going to hire people, higher quality people, and can understand what the machine is doing. And those people over time will need to know more. So you have the opportunity. So artificial intelligence is giving you the ability to learn much more than I learned in my life. On the other side, in a few years, you will be expected also to know much more than you were expected 5 years ago. So I think this is very interesting for the future.
So with this, first of all, a huge thank you to Francesco Castelli and Banor Capital from London. I hope we all leave the room with a bit more than what we came in. I think so. I think it was very interesting. Thank you to all of you and to the people online. Any questions, write to academy@mercurypartners.net with any comment if you want, or any suggestion for future events. We have very good guests also for next week, over the next 2 weeks, like Francesco, on different topics. So stay tuned, keep being interested, keep being hungry, and keep following Mercury Partners Academy. Bye-bye, thank you.